A very warm welcome, everyone. Thank you for joining us today for our webinar titled How to Mitigate Risk and Navigate Regime Shifts with Explainable AI. I'd like to begin by introducing our speaker. Davison is the Managing Director of Customer Success at Boosted.ai. He started his career as a financial services advisor for Ernst & Young, and most recently, he was the head of business development at Variant Perception, a global macro research company. He earned an MBA from the Darden School of Business at the University of Virginia and graduated from Duke University with a BA and John Hopkins University with an MA. Without further delay, I'll pass it on to Davison.
Right. Yeah. Thanks everyone for joining. So yeah, today we're going to be going over using machine learning for risk management. We've got three topics we're going to go over. First, building low volatility models. Second, machine learned factors. And third, machine learned hedge baskets. First, starting with low volatility models. This isn't traditional risk management, but I think it's relevant to the topic anyway. So there's a few different ways we can reduce volatility in models. And the idea being if we have lower volatility models, then we're going to be less exposed during drawdown. So first, we can add more stocks to a model. A lot of our clients are long only and may trade 15 or 20 stocks at a given time. And that's necessary because you got to do deep analysis on those stocks. But with machine learning, we can rank every stock in a model from first to last and say, in a Russell 1000 model from first to 1000. So we can easily add 100 or 200 stocks to a model and thereby reduce the volatility of that model. We also have optimizers. So we'll go through an example in a second of a reduced risk optimizer that's basically going to reduce the covariance of stocks in a portfolio. So say you have your top three holdings are all stocks that are moving together, then we can recommend reducing the weight on those stocks so that you're going to be less exposed when those all start to move downward at once. Combinations, we're not going to go through in detail on this call, but basically we can combine signals together. So say you're a quant and have linear signals, or say you have random forest signals, which is another machine learning algorithm. You can combine those with our battle royale machine learning algorithm, with the idea being that if both are strong models, if you combine them together and they're not correlated, which our battle royale model tends not to be, then the resulting model tends to have much less volatility. And then we also have factor controls, which we'll go through in the next section. But I'm going to switch back and forth throughout this to keep it interesting. And we're going to go through a couple of different examples. So starting off, we're going to be in a Russell 1000 model. This model is market neutral, so it's 100% long by 100% short. If you looked at this one, you can see it's like fairly volatile. It's 20.46% is the standard deviation. You can see there's some significant drawdowns here. And then just going through two of those things we mentioned, if we add more stocks, so the first tab had between 25 and 50 stocks on the long and short side. This one's increased it to 100 to 200 stocks. And by doing that, we're decreasing the standard deviation all the way down to 13.12%. And then taking that model and then adding our reduced risk optimizer. So getting a little more detail on that, basically, say we have 100 stocks, we're going to then not add or remove any stocks, but we're going to basically re-weight them so that the covariance between the stocks is maximally reduced. And so by doing that, you can see the returns are now significantly smoother. And our volatility is all the way down to 5.69%. And then we're going to go through a factor controlled version in a second when we get to the next section. But going into another example, this is a long only R2K model. So I want to give a couple of different examples to make sure we're showing things that are relevant to everyone on the call. This one on the default version, we have a Sharp of 0.69, standard deviation just a little bit less than the benchmark. And then our annualized returns are 16.2. All we did here was add our reduced risk optimizer. And in doing that, our standard deviation has declined all the way to 17.05%. Our Sharps up to 0.91. And then our annualized returns are down a little bit, but only slightly. So you went from like a little over 16 to 15.95. So we sacrificed just a little bit of return for much less volatility in the portfolio. So going back to here to summarize this section, we're able to use a number of tools to reduce volatility of models. You could think of this either that you could build a model on our platform and we can use these tools to reduce the volatility of it, or you can upload your portfolio to the platform actually, and we can use these same tools to analyze your existing portfolio and make some of these recommendations based on these tools that we have to reduce volatility. Second, we're going to go into machine learned factors. So the status quo across the industry, most people use bar factors. So those are things like value, growth, momentum. The problem with that is obviously they can work and they can reduce your risk, but for one, it's industry standard, so you're not really gaining an edge by using those. Also, they're not dynamic, and as a result, you're going to miss idiosyncratic factors. And so for like COVID, for example, you may have been somewhat covered by some of those bar factors, but COVID is not a bar factor. And earlier this year, when interest rates and inflation became a problem, similarly, those are not bar factors. So you're going to be exposed to a lot of times when these biggest drawdowns happen, they come from things that you're not expecting, and you could get broadsided by them if you're just using the bar factors and think you have control over all the risk factors in your portfolio, but a new one arises out of the blue. And so we're going to go through how we attempt to solve that problem using machine learning. So back to the initial model, we're going to go to the first tab that we were on and go to factors. And then how this works, anything on this chart that's not crossed out is shown on the chart, basically. So I'm going to go to just show machine 1, 2, and 3. So basically what these machine learned factors are the machines finding stocks that are moving together. So there's actually hundreds of these machine learned factors. And we always use the COVID as an example. So during coronavirus, say January of 2020, basically COVID was probably machine learned factor number like 70, for example. But then as we got to March, then COVID became machine learned factor 1. So the machine was basically picking up on the fact that hotel stocks and cruise stocks and restaurant stocks were all moving together. And we're able to then identify that as a risk factor. And then if we're trading a model directly, immediately control for it. So you can see in this model, if you look at on the left side of the y-axis, these are in standard deviations. So we're at various times 2 standard deviations above the mean exposed to these machine learned factors 1, 2, and 3, which can be concerning because you might think that you don't have too much risk in your portfolio, but you're very much exposed to these factors at various times. I can show you graphically how this looks when we can then control these factors. So this was on the first model we had shown. We had the standard deviation down to 5. By controlling for these machine learned risk factors, we're now brought the standard deviation all the way down to 2.33. We definitely sacrificed some returns, but this is now like a very low volatility model. And if you look during coronavirus, during 2020, we had positive returns all the way through July using this feature. And if you go to factors, you can see kind of optically how this works, where I'm going to turn these bar factors off and turn these machine learned factors on. And you can see the y-axis is now changed. So we're basically controlling, we set these to control between a quarter standard deviation of the mean on either side. So we're not very exposed to any of these risk factors throughout the backtest. And so we've managed to successfully do that. So you can see before we were going up to like 2 standard deviations above the mean, down to 2 below the mean. And now we're staying within a quarter standard deviation on either side. And as a result of that, you can see in the results that our returns are very smooth. And yeah, we did well during COVID. And then I'm going to give another example of this one as well, just again, to give examples that are relevant to everyone. So this is a long only Russell 1000 model. So in this first version, there's no factor controls on. So you can see here, we didn't do great during COVID. Like the model was down February, down significantly in March, down in April, down in May. We go to 2022, we're down January, February. And then this year, interestingly, we were showing this model a lot throughout this year. And then this model is very much rebounded, is now up 8% on the year. But when we control, all we did on this, we didn't do anything in that first section with the low volatility. All we did was control for these machine learned risk factors. And then by doing that, we now see that we still took a hit during COVID, but we went, I think, from down like 19 to only down 9 in March. and we were now positive in April and May. We still lost a little bit in January of 2020, but we did well in February and are now up 19% overall in 2022, just making that one change to this model. And so the next part I'm going to go through, the obvious question that then follows is, what are these machine learned risk factors? So we can start to answer that. The first way we answered that was by going to the stock data table. So just take 1 second to load, and I can click on machine one here to have it show on the chart, and then sort by machine one. And then by doing that, we can see which stocks are most exposed to machine one. So this is in our Russell 1000 model, but we also could do this with, say you uploaded your portfolio. We could say, what's your exposure on every single stock in your portfolio to machine one? And then by doing this, we can start to see what's actually in machine one. So we can see here, there's a semiconductor stock number one. There's a lot of like software here. You see Cloudflare, Datadog, I guess Peloton's somewhat software. And then, so this was our next step where we could start to see give exact transparency into what's in each of these machine learned risk factors. We've also taken that a step further where we can then go to semantic risk factors. And what we're doing here is using natural language processing to tag each stock. So we're looking at all the data that we have. We're looking across Wikipedia and trying to find, like, what are these stocks that are most exposed to machine one have in common, and what are the stocks that are least exposed to machine one have in common. So the idea here is that cloud computing stocks are moving in one direction and opposite of natural gas and foods. And then machine two, it looks like, is a reopening basket. So it's cruise lines, airlines, oil and gas moving together and opposite of pharmaceutical and software companies. So this isn't perfect. We're not able to label machine two as, say, reopening. We're working on a second version of this, but we're able to give you a decent amount of insight into what these risk factors are so that you feel more comfortable acting on the information here. So, but yeah, so basically we're able to identify risk factors and then control for them. So that's our machine learned factors section, and then hedge baskets. So there's a number of use cases for hedge baskets. I mean, there could be you traded a stock pre-IPO and you're locked up, or you could be an RIA and one of your clients works at Starbucks and they have restricted shares but they want to hedge out their exposure to it, or you could be a hedge fund and want to reduce your exposure to a stock in your portfolio or a group of stocks. And that's where hedge baskets come in. And so the status quo is most people in the industry now either go to their prime broker and ask for a basket, or they short just an ETF. So you might just short SPY or a sector that's closely related to the target stock. The problem with that is the stocks aren't often very similar, especially with the ETF method. And then you're also not generating alpha on the short side. So we're going to go through an example of what we can do on the hedge basket side of things. So if we go to similar stocks, we can type in any stock here. So I'm going to type in Microsoft, and then we can immediately see stocks that are similar to Microsoft in a number of different ways. So here we have correlation. So we can sort by correlation to see the stocks that are most correlated to Microsoft. So you see Google, Adobe, MSCI are the top three. We also have this price similarity, which is taking that to another level. So we're using covariance and machine learning to find stocks that are moving with Microsoft. And so using that method, sometimes we find some like non-intuitive results. Here we're seeing healthcare stocks in the top three. We're seeing Agilent, EW, and IQV as the top three. With data similarity, we're showing stocks that have data that's similar to the target stock. So in the case of Microsoft, whatever data we fed the machine for this model, in this case, a lot of fundamental variables like return on equity, price to sales, we're finding stocks that have data that looks like Microsoft. And so in this case, APH, STX, Tech are the top three. And then our overall similarity, these are stocks that we're finding that to be most similar overall to Microsoft. So Agilent, EW, and Apple are the top three according to our tool here. Some of our clients like the ability to find counterintuitive hedges. Others, couldn't imagine shorting Microsoft with a healthcare stock in the basket. So we have the ability to filter by sector or subsector. So if I go by IT, in this case, just limiting the universe to IT stocks. We have Apple number 1, S&PS number 2, and Keys number 3. So that's the first step. And then all we have to, we can, from there, we can generate a back-tested portfolio where first we can specify the number of stocks. This can be a somewhat risk management in that we definitely recommend going higher in number because you can get blown up on the short side if you only have like 10 or 20 stocks in your short basket. Here, we're equal weighting that price and data similarity. We can factor in other things like factor weight, beta weight, how similar is it in terms of factors, beta, ESG scores. We also can, which is interesting, factor in our machine learning scores. So this is where we can generate extra alpha on the short side, where if we have a stock that's similar to Microsoft and also the machine really doesn't like it, in this case, because we're shorting it, then we're more likely to include it in the basket and weight it higher in the basket. And then these run fast. We could run a result here in like 10 to 15 minutes, but I went ahead and ran this just to show it, so we didn't have to wait on a call. So for Microsoft here, this is the black line here is 100% long Microsoft, 100% short SPY. And then the blue line here is 100% long Microsoft, 100% short our basket. You can see here we're outperforming every year, 2020, 2021, 2022. Similarly, if we had shorted XLK, the technology sector spider, we're also outperforming every year using our machine learned basket that just more dynamic in finding similar stocks than in using that alpha generative component. And what I'm going to do now, just to try to make this more interactive, we can do this on the fly. I'm going to go back to similar stocks. And if we're in an S&P model, so it has to be a stock that's in the S&P, but the first person that puts in the chat a ticker of a stock in the S&P, we can use that live on the call and just kind of go through the same exercise. If I don't see one in the next 20 seconds, I'll just pick another one. But yeah, if anyone has a ticker in the S&P, we can do that on the call now. I think I just saw DHR, so assuming that's in the S&P, there it is. So thanks for that. So Danaher, so healthcare company, correlation, stocks most correlated according to this is TMO number 1, WST number 2, and bio number 3. If we go to price similarity, we're still finding healthcare stocks in the top 3 in this case. So the machine's finding a little bit less counterintuitive results in this case by default, but we're seeing WST number 1, TMO number 2, bio number 3. Data similarity, we're finding a little bit more counterintuitive in this case, Google number 1, Agilent number 2, and Qualcomm number 3. And then overall similarity, we're seeing West Pharmaceutical number 1, MTD number 2, and Agilent number 3. So similarly here, we can also filter this by sector, by healthcare, and let's sort by overall, and we can see that WST is number 1 in healthcare, MTD number 2, and Agilent number 3. So not much change in this case. So yeah, that's another example there. If there's another time in the end, we can do another one towards the end of the call. Go back to the presentation. So that's hedge basket. So yeah, we're able to basically create hedge baskets with stocks that are more similar to your target stock. We also can do it to a group of stocks, and we also can create a hedge basket across your entire portfolio. And we're also able to generate alpha on the short side. A lot of our clients are long only and don't have interest in really spending a lot of time on the short side, so we're able to really help them on the short side there. And then it's going to summarize some of the results. So first of all, we went through that R2K long only model. So the volatility of that model, we reduced from 22.7 to 17.06. The annualized returns went down a little bit, but we increased the Sharpe from 0.69 to 0.9, and the returns went up in 2022 from 8 to 12. In the next model, this is the machine learning. Go to this. I skipped over this earlier, so I'm going to go through this quickly here. So this is another example of the factor controls. So what we're able to do on this one, all we did on this version was we had no factor controls on this. This is an R1K model, and yeah, it didn't do very well during COVID, but then yeah, it did also didn't do great in 2022, and then yeah, as we'd seen here, this version did much better during COVID and early 2022. So highlighting it here, the volatility was a little higher in this case. We could have done, if we had done some of the low volatility things we mentioned in the first section, we probably could have gotten this down further, but just all we did here was limited to those factor controls, and we were able to increase the returns from 24 to 29. The Sharp went to 1.1 from 1.15 to 1.24, and the 2022 returns went from 8 all the way to 19, just making that one change. And then the hedge baskets, we had volatility go from 15.8, slightly reduced to 15.2, but we were able to increase the return significantly from 11 to 24, and our 2022 returns went from negative 2.3 all the way up to 4.6. So I'm just going to end. We always like to emphasize that overall, we think the best results come from utilizing human plus machine learning. Both have their advantages. Humans, just to give a couple of examples, can do deep fundamental analysis, can factor in intangibles that we can't feed the machine, and you can even like visualize the future, to name a couple of things. Machines are non-emotional and are able to calculate a massive number of calculations quickly, and able to pick up, nonlinear patterns. And so hopefully this is an example. We gave a couple of examples today where we can, have a client utilize these machine learning tools kind of around the margins to find ways of reducing the volatility or reducing your drawdown risk in your portfolio. So with that, I'm going to hand it back to SK for some Q&A.
Thank you, Davison. We have some great questions from the audience. We'll try to get most of them with the time we have at hand. First one, can you speak about the macro variables you are using, as presumably these forecasts can't be completed with only alternative data?
Yeah, that's a great question. And I didn't go through that in detail on the call, so it's definitely good to bring that up. So if we go back to this initial model that we were in, if we go to variables, we can see these are the data that we trained this model on. So if we go down here, there's some technical variables here, a lot of fundamental variables. And this one up here, you can see the macro variables. So we didn't give it a lot, but we have 2 yield curve variables here. We have 10s minus 2s and 10-year minus 3 month. We have the 10-year treasury, 5-year forward inflation, VIX, an exchange rate, and US dollar index. So this is an important point because basically the machine doesn't know anything we don't feed it. So these are the variables we gave it. If we didn't give it these macro variables, it would have no idea what they are. It wouldn't be able to do anything with them. But in this case, it's able to utilize these macro variables because it can basically see that, say, if the yield curve's inverted, that in the past, when we've seen that pattern, then these patterns or these factors matter. But when the yield curve isn't inverted, when the yield curve's steepening, then these other variables matter, and these other patterns that the machine's found are what it's going to utilize. So this can also help with risk management, just fundamentally with like a machine learning model, where the machine is able to, have more a dynamic view on the market, where we're not just going to say, like with my simple investment strategy, maybe I would just say, like, I like stocks with return on equity greater than 20%. The model might find that works great in most environments, but if the yield curve inverts, then that's actually a bad strategy. So yeah, we definitely can utilize macro variables. We have a number of them in the system by default to better improve the models and from a risk management standpoint.
Thank you, Davison. Appreciate that. Next question: how can I blend macro investing with quantitative tools?
Yeah, there's 2 ways of doing that. So we can either like bottoms up, look at the model. So we can go into this one and say, go to stock data table, or sorry, let's go to historical charts. we can see the average score in the model for each sector. So we can see right now this model likes utilities number 1, consumer staples number 2, energy number 3, and it does not like financials and consumer discretionary. And how we're arriving at this is more of a bottom-up method where we're taking what's the average score for each consumer discretionary stock. And in this case, it's 1.8 right now. So from a bottom-up standpoint, we don't like consumer discretionary. We also, from a top-down standpoint, we can basically, if we say we're doing a sector model, we can have the machine train on every sector spider. So it'll be given things like XLK, and then it can then, instead of having every stock in the Russell 1000 to learn from and to pick from, it's going to have just those ETFs to choose from. And we can do the same analysis that we were talking about today on those ETFs from a top-down standpoint. And then the machine can decide, like, right now I like XLK number 1, and on down. So yeah, we can use either method currently, and they both have their pros and cons.
Thank you. Next question. What is Boosted.ai's machine learning approach to deal with rare events such as the pandemic?
Yeah, so I can go back into, I guess we're on this one, so I can go back to here. We already touched on this earlier, but you go back to this model. So this is with, make sure I'm on this one. So this one, we're doing the risk, more stocks. We've got the reduced risk optimizer. We're factor controlling it. And then you can see that there's, we're making money throughout COVID every month. And then if we look at this other one that I touched on, yeah, so similarly, yeah, we struggled. This is the factor controlled version. We struggled before. We did much better during COVID with these risk factors on, and then we also did better in 2022. Interestingly, kind of where I would say, just so people don't think like machine learning is like a panacea, that we struggle probably the most when there's a big regime shift. Because you think about machine learning, we're training on, say, the 8 years prior data, and we're finding all these like patterns. But then if all of a sudden there's a regime shift and what worked over the last 8 years no longer works, at least for a short period of time, we can struggle. So you can see that in this non-factor control model. This is just would be like a basic machine learning model. Struggled in COVID, struggled early 2022. But interestingly, it did well without any factor controls during these recent troubled months. I think that's because it's seen it before. The machine had, through its training period, had seen, this instance there wasn't any kind of major regime shift. The regime shift, that's where our factor controls come in. That's where, if we're controlling for all these machine learned factors, if there's any major change, any regime shift, then we're going to be able to control for that immediately. Either if you're trading a model directly, then we can immediately control for to the next rebalance period, or say you've uploaded your portfolio, as I mentioned before, you could go in here and say, just 1 second for this to upload what stocks in my portfolio are most exposed to machine 1, and then consider down weighting it. You also can see our machine learned scores alongside it. So if we had GameStop or TXG in the portfolio, it's highly exposed, and we saw that you're exposed to machine 1, we could then recommend reducing these, because not only is it highly exposed to machine 1, but also we don't like it from a machine learning standpoint. We don't like GameStop or TXG.
Thank you, Davison. Great explanation. Next question. Can your solutions be applicable to other asset classes other than equities?
Yeah, so like right now we only focus on equities. Our plan next is to add fixed income. Probably won't happen this year, but most likely, or it'd be more likely to happen next year. Eventually, we plan to add hopefully every asset class, so we could add options, futures, even cryptocurrencies, FX. But yeah, our plan is to add fixed income next. It takes a while to like clean the data and set the platform up for a new asset class, but over time we plan to add hopefully all of them to the platform.
Thank you. Very quickly, I know we're at the top of our time limit, but how have your models performed recently? I think you touched on that already.
Yeah, I guess I just touched on that. So yeah, I'll just reiterate that quickly. Recently, they've done very well, pretty much not completely across the board, but very well overall. And so you can see in this model with no factor controls, up 5% March, April, 2% May. And I think, yeah, again, that's because kind of to the earlier question where we've got macro variables in here. The machine has seen this kind of environment before and was able to react to it and find some patterns where, in this sort of a trading environment with, say momentum trending down, like how to react to it. So it's handled this much better by default this last 3 months than say the regime, what we would consider a regime shift during coronavirus and the beginning of this year. And that, again, that's where like the factor controls are really essential.
Thank you. We'll just take our last question, and then for all the questions that we couldn't take, we'll follow up on email. But here goes. Can you show a hedge basket for Pfizer? Interesting.
Yeah, you can do one more. So if we go back to similar stocks, we have data here. So we put, I think it's PFE, Pfizer. So we look at correlation. Stocks most correlated to Pfizer are Bristol Myers, Johnson Johnson, DGX. In terms of price similarity, and again, that's stocks that are moving with Pfizer. We're seeing Regeneron, Ball, which is a materials company, interestingly, and LH. In terms of data similarity, we're finding NUE, Caterpillar, and IT, and then overall similarity, Regeneron, AXAM, and Ball. So the top three are, especially number 2 and 3, are fairly counterintuitive. And then again, if we sort by or just filter by healthcare, we can see that it becomes Regeneron, DGX, and LH as the top 3, Abbott number 4. So yeah, that's a quick rundown of what we see in terms of Pfizer.
Thank you, Davison. Thank you for taking the time today and doing a great presentation. I'd like to say thank you to everyone who joined us.